Hello, I'm Finola Burke from RaaS Research Group, and today we're focusing on Pureprofile, ASX ticker PPL. Joining me to discuss the company's recent Q1 FY26 results is CEO and Managing Director Martin Filz and COO CFO Melinda Sheppard. Welcome back, Martin and Mel, and thanks for joining me.
Hi, Finola. Thank you for having us.
Hi, Finola.
So starting with you, Martin, Pureprofile has reported a 15% increase in both revenue and EBITDA for Q1, with rest of the world now 51% of total revenue. What regions were the key drivers of this growth, and do you see any benefit in this result from your automated client solutions?
A great question. Thank you for that, Finola. Go straight into them. The rest of the world, all of our markets are doing well and did well in quarter one. I think for us, we've got particularly low market share outside of Australia, and we're against the same competitors and delivering the same great solution we do. So why we win in Australia, continuity of delivery, trust in the brand, high quality, that works it stands the same for all the other markets. And so we saw it across our remote teams working with US clients, UK, Europe, and Southeast Asia. All of them grew really well. So very excited about that. With the new products, great to launch the new products, and especially Data Rubico, which we launched in the last quarter of financial year 25. From an external client-facing solution, it was still a soft launch phase. So we're rolling out new clients and new clients using solutions and using the period to do a bit of tinkering, which basically is finished now. So it's moving forward for full release. But the challenge for Data Rubico is it's following an ever-moving feast. And so with the rest of the world growing, sort of 34%, winning that market share in our traditional research, Data Rubico will carry on following that. Now, some of the advantages of Data Rubico, we rebuilt the platform, our internal platform, as part of Data Rubico, and actually our internal teams are using that automation of working with clients, working with third parties where we need to. And so that's why you saw that growth in platform for the quarter, and that makes us faster for clients, keeps the same quality. And so we'll see revenue growth actually because of the tools we're using, not just because of clients moving to Data Rubico.
And you provided revenue guidance of 63 to 64 million and an EBITDA margin range of 10 to 11%. Can you give us some insight into why the tight revenue range, and how confident are you of delivering on your margin guidance?
Yeah, that's correct, Finola. We typically actually at our AGM give out a much broader range, particularly for the revenue. The EBITDA margin range is typically a little bit narrower. Look, this year, after quite a discussion with the board and looking at where we are after the first quarter, we really feel comfortable with that tightened range this year. We've got good visibility and confidence in our plan at the moment. After Q1, we're tracking exactly where we thought we would be, which is fantastic. So that strong start's really given us some confidence in how the rest of the year could shape up. We've obviously got really strong annuity revenue, and we've had strong repeat business. So that really gives us a bit of predictability across the quarters. In addition to that, we've also made some targeted investments in 3 new senior sales heads outside of ANZ in the key international markets that we're in. And that's going to help us drive incremental growth required to meet this guidance. So from an EBITDA perspective also, we've obviously made some investments over the last 12 to 18 months, really around automation, AI integration, and also launching some of these higher EBITDA margin solutions. So that's really, we're starting to see those efficiency improvements already. And so whilst we're continuing to invest, we do have a good degree of confidence in our plan moving forward, and as such, allowed us to make a much tighter range this year. But as always, we'll continue to review and we'll update every quarter as we progress through the year. But right now, we feel confident about delivering our guidance.
So, Martin, you've flagged that you're looking to expand your US footprint through acquisitions. Are there any opportunities presenting themselves, and how realistic are vendor price expectations?
Yeah, again, yes, we have talked about that, Finola. Look, the last 5 years we've been very successful in growing organically as a business. So clearly, acquisition like we bought iLink in Australia last year. Only Australian business contributed about 7% of the growth that we saw in Australia last year. And so buying an organization in the US gives us a step change in our revenues, puts boots on the ground, and really is the homeland of where our serious global competitors are. That again, we're winning market share in the rest of the world. But it's not something at all we're going to rush into because we're really happy with our organic growth. We'll be really mindful also of EBITDA multiples where we're trading and what makes an acquisition accretive to our shareholders, non-dilutive to our shareholders at the point of purchase, and also what is manageable for us. And as sure as anything can be that it'll be successful. So we don't want to extend ourselves both financially and also at EBITDA margin. iLink has given us a nice blueprint of what's been successful for us as an integration, as an acquisition. But as I said, we're happy to see where the growth is organically, and so it'll need to be the right opportunity that comes across our desk that makes sense to us.
Mel, you ended FY25 with 5.7 million in cash and have a much stronger balance sheet than you had 5 years ago. Are capital management initiatives being considered?
Yeah, so that's right. We had probably our strongest year from a cash flow perspective during FY25 and ended the financial year with 5.7 million in cash, and we fully funded the acquisition of iLink as well as paying down a small amount of debt. So it was a great year. And yes, correct. We have strengthened our balance sheet significantly over the past 5 years as we've, improved our financial fundamentals every year. But right now, our focus does remain on disciplined investing to continue that international growth. That's really important for us. We want to continue to focus on product innovation, AI development, and expanding that international sales capability. So that's what we're focused on. We do, however, constantly review our capital management options with our board. A lot of important conversations go on around that, and we want to make sure that we're investing our capital in the most effective way for our shareholders. So we'll continue to balance those options, look at debt reduction where it's appropriate, and also assess other opportunities as they come along. But at this point in time, we believe that our current strategy is the best return for shareholders at the moment, and we'll continue to assess our opportunities as they come up.
And Martin, you've made a lot of investment in obviously the business. Could you give us a sense of what you see the shape of Pureprofile looking like in a few years' time?
We certainly have. Our proactive investment really is in that rest of the world. From 5 years ago, we said we'll roll out being global strategy, or the first pillar of our strategy is to be a global organization. And so that has been a focus for us. And now that investment's paying off. The second pillar was about technology. So you've seen platform grow from nothing to sort of 20% of our revenue today. So technology has been, and then focus absolutely on data and insights. So to me, when I look to the future, I see US and UK continue to grow at the CAGR level we've seen to date and start to really be the majority of our business. Technology platform continue to grow, and we call both those out and call out trebling of platform, trebling of the US business as well. So more of the share through our platform, more of the share through rest of the world, and then continuing EBITDA margin expansion. And if you look at the top end of guidance this year, we're saying that would have grown our EBITDA margin 30% compared to where we finished financial year 25. So it's much of the same moving forward as Pureprofile.
Well, thank you, Martin and Mel, for joining me today to discuss Pureprofile's Q1 results. I'm looking forward to catching up with you through the course of 2026 to check on your progress.
Thanks so much, Finola.
Brilliant. Thank you, Finola. Take care.